Welcome to Module 3. This module will provide an overview and guide of how to build your sharing business model. It will provide an executive summary and visuals of the content. In this module, we will look at the sharing business model compass, which consists of the business approach, the shared resources, platform type, transaction type, technology, and governance. We will then look at how you can go from products to ecosystems. Then we will look at scaling your business. And finally, we will look at the case study of Parkfly Rent. Building a sharing business model requires consideration regarding a new set of topics that go beyond business as usual. Where traditional business models usually focus on in-house activities until the end product leaves the company gates, sharing business models focus particularly on managing the end product once it has entered the market. The business model canvas is a widely used framework for strategic management and mapping out a company's business model. Within a sharing economy, the business model canvas still holds value. However, it doesn't cover the full spectrum of trade-offs that an entrepreneur should make when building a sharing business model. In response, the sharing economy model canvas was developed. Additional to the sharing economy model canvas, the sharing business model compass was developed. These tools are useful in demonstrating that there is a plethora of key decisions unique to the sharing economy that entrepreneurs must make along the way. A total of 6 key dimensions are identified that form the basis of the compass, consisting of the business approach, shared resources, platform type, transaction, technology, and governance model. When starting a sharing business initiative, the first question entrepreneurs probably want to answer concerns the nature of their business approach. What is the main purpose of the business? Making money or delivering some other type of value? Sharing business models have excellent potential to deliver a wide spectrum of values on the economic, the social, and the environmental dimension. Therefore, the mission, which is the license to operate, can be formulated in broader ways than simply generating profits for business sake. Determining which of the two has your focus as an entrepreneur will help you align future decisions with a business approach. In practice, the vast majority of sharing initiatives will be hybrids, striking a balance between their mission and generating profits. Modern businesses have a hard time branding themselves if they fail to articulate their mission or added value to society. At the same time, continuity of a business depends on its cash flow, so it must, to some extent, be focused on generating profits as well. Putting it simple, a good story will make your business, and business will allow you to keep telling your story. It's a back and forth principle that keeps repeating itself. Choosing your focus will have implications on other choices that you make, for example, the transaction type and governance model. The sharing economy is all about optimizing underutilized resources in society. Therefore, it is important to determine 1. What is the exact resource that will be shared? And 2. How is this resource going to be shared? Knowing exactly what it is that will be shared is not always clear at first instance. For example, car sharing and ride sharing both involve the object of a car being shared. However, with the principle of car sharing, the user gets temporary ownership of the car as a whole and is able to travel wherever he or she wants. This is fundamentally different from ride sharing, where the start and final location of the ride is predetermined, and it is actually the seat or seats in the car that are being made available. The honeycomb, see this picture, is a useful framework to gain understanding of the wide variety of sharing in industries and subcategories. Even though your exact initiative is not represented in this honeycomb, it can still serve as an inspiration for what type of initiatives exist that show similar traits as yours. Lastly, it is important to understand whether your shared resource is a commodity or not. Commodities are resources which have few characteristics of how they differentiate, whereas non-commoditized resources can be very different from one another. Amongst other things, this influences the way in which resources are presented on a platform and how the matching takes place. As an example, the homes that are offered on Airbnb come in all shapes and sizes. The person who wants to rent probably has very specific requirements when looking for a suitable place to stay, which suggests that the characteristics of the resource matter a lot in making the right choice. We can state that this type of resource is non-commoditized. An example of a commodity resource is, for example, ride-sharing through BlaBlaCar. Most people probably don't care about the brand of the car as long as they get from A to B. This means that the sharing platform has to take less variables into account in order to make a proper match between providers and consumers, and the matching could even be automated. Next, we're going to talk about how the resource is actually going to be shared in the market. The Compass provides three possible solutions. Through underutilized, providing temporary access to resources that are suboptimally used by their owners. New home for used. Shifts in ownership when the initial owner has no longer use for the resource. And optimize new, making new products available to multiple users instead of selling them to just one user or owner. Fundamental to these three options lay two main principles. Either users get temporary access to a resource, also called access-based, which equals underutilized plus optimized new, or the ownership of the resource shifts from one person to another in some sort of marketplace, which is called marketplace new home for used. In this light, the scope of the sharing economy extends beyond simply providing access instead of ownership. When resources stand idle after they have been used, for example, a book that has been read, they can be assigned to a new owner who will utilize it once more. This eliminates the need to buy another book in the store as the resource is shared multiple times over its lifetime. Choosing a platform type is all about which parties you need to connect in order to get your resources shared. In any case, a sharing platform should function as both a meeting place, online and or offline, and a matchmaker, connecting supply and demand, ideally in a smart and automated fashion. The main distinction on a sharing platform is between the owners of the resource, which can be your business itself or external providers, and the users of the resource, consumers, which can be both individuals as well as collectives of individuals, for example, businesses, schools, or municipalities. As the initiator of a sharing initiative, you also must determine your own role on the platform. Are you only facilitating or moderating external parties on the platform? Or are you also owner or provider of the resources that are being shared? Choosing between these two options leaves you with two main opportunities for creating a sharing business. You can either be the provider and providing flexible access to the end products or assets of your business. Or you can be a facilitator, facilitating a sharing platform for owners and users of a resource. Sharing is, besides an economic concept, also a social concept. This allows a sharing platform to organize transactions in ways that differ from the traditional market approach. When considering the transaction type, it's important to consider these two questions. How does the transaction take place, and how are revenues generated? The Compass identifies three main variations in transaction types, starting with the market transaction. This is the most familiar and therefore the most used form of transaction. In this way, the resources are temporarily acquired in return for a fee. Some ways of doing this is through a service fee, where the company takes a service fee for successfully matching buyers and sellers, hosts and guests, and borrowers and lenders. The fee taken varies across marketplaces from 5% to 40% depending on the value of the transaction and the support services provided. Another way to do it is a membership plus usage. Company charges a one-off or annual membership fee, sometimes with the different plans offered based on frequency of use. Additional fees are charged based on usage. The next way is the alternative transaction. where in return for temporary access to resources, the platform works with currencies that are different from the monetary currency. Examples of such can be found in cryptocurrencies and time banks. This way, the added value is bound to the platform and can't be spent elsewhere. The main business model that supports alternative transaction types usually lays in a monthly or annual membership fee for using the platform. Next, we have the free option. There are plenty of sharing initiatives out there that offer usage for their resources for free. For example, city bikes that can be accessed through a mobile application. The business model for this transaction type does not lay within the transaction, but rather in sponsorship and advertisement. Offering a product or service for free can create a lot of traction, making it interesting for third parties to use the platform for their promotion. In the case of Peerby, the platform that enables consumer goods to be shared, they started with the only option of exchanging items for free. However, after interviews with platform participants, Peerby found out that people also wanted the option to pay for items. The founder, Dan Beddepoel, said in an interview, "Borrowing is actually asking for a favor. You only do that occasionally, but you don't do it every day. You build up a social debt and people don't feel comfortable with that. Paying to rent is a way to make that relationship equal." Modern platforms are usually to some extent based on technology. When thinking about the technological aspect of a sharing platform, two questions must be answered. What level of technology is desired in managing a sharing platform, and what type of technology matches the business model? The Compass formulates three possible answers to the first question of what level of technology is desired. Sharing business models can be tech-driven. Tech-driven business models are the ones that leverage technology not just to connect users, but also to complete the transaction without the need for offline interaction. Examples of tech-driven business models can be found in crowdfunding platforms. They can also be tech-enabled. The majority of startups fall in the tech-enabled domain, which represents business models reliant on technology to facilitate the connections, but require or are enhanced by offline interactions. Examples of tech-enabled business models can be found in the platforms like Airbnb, where online booking and offline usage complement each other. The third one is the low or no tech. While most of the sharing initiatives out there are at least enabled by technology, there are still many startups in the sharing economy where technology is, at most, a supporting tool, but not critical. Examples of this can be found in co-working spaces and shared commercial kitchens. Low or no-tech startups are usually local initiatives that are known and used by the local community. There are many types of technologies that could be relevant and associated with the sharing economy. For example, review and reputation rating systems, online payments, geolocation, artificial intelligence, blockchain, big data analytics, and so on. The level and type of governance is closely connected to the level of community among users of the platform, as explained in Module 2. The Compass further formulates three options for governance of a sharing platform that are closely related to the business approach. Starting with corporate governance. Here the governance on the platform is provided by the initiating business. At a minimum, compliant policies and accountability systems are in place. Most of the bigger and more successful platforms use this type of governance model. Next, we have collaborative governance. Here, governance is provided by working with users and other stakeholders in sourcing, implementing, and monitoring the platform. This form is not commonly adopted, however, it is expected to grow significantly over time, as the benefits of deeper engagement with users on the platform become more tangible. This way, users don't just execute a financial transaction with the business without any further engagement, but a community based on collaboration is built. Last, we have cooperative governance. Platform cooperativism is a governance model where authority is distributed among the different users and stakeholders. According to research, this model has yet to gain traction, although there is a big drive from within the sharing community to support more platform cooperativists. The governance type depends very much on the business approach and the level of community and technology embedded in the platform. As mentioned in Module 1, in the current economy, consumers cannot engage with only one party to satisfy many or all of their needs. Traditional companies can utilize the sharing economy to create solutions to satisfy a whole experience rather than separate products or services, focusing on an ecosystem value rather than individual customer value. Have a look at this picture to understand further. To put this further into practice, we can have a look at this example of the microservices that could be considered when hiring a babysitter in the sharing economy. Scaling within the sharing economy was briefly discussed in Module 2 in connection to the community and how the motivations and drivers of your target group may be different on a local versus a global scale. It was also suggested that reaching a larger scale is not always desirable or even in the best interest for some initiatives. Connecting to the business model, there are many things to further consider when scaling, such as market features, the type of resource that will be shared, and how the sharing process is managed. There is no one-size-fits-all roadmap for scaling. It can be tricky, and following will provide some extra pointers for scaling as a sharing business. As mentioned earlier, start with considering the purpose and value proposition of your business and whether this matches with the ambition to scale, since you may risk losing the purpose. Serving a larger and more diverse target group can make you lose authenticity as a platform. Determining scale relates to many aspects. It is crucial to achieve proof of concept and fine-tune locally before considering scaling. Consider the type of community you serve, both online and offline, as well as its cultural aspects and whether or not it is suitable for scaling. Additionally, building a community on a larger scale requires continuous work and to find the balance between supply and demand. The type of resource that is shared will impact the possibility of scaling, as will the management of such resources. Always research upfront what the implications could be. When scaling, you will compete with larger companies and you will have to match the value of traditional alternatives, for example, ensuring seamless transactions and a smooth experience. Your company infrastructure also needs to be in place for the scaling. For example, the customer service and community management need to be in place. You also need robust procedures across operations and engineering, and a flexible workforce for peak moments in demand. Lastly, it is important to empower your team and users with technology. Preferably develop your own content management software and establish automation of processes for handling payment security and simply processing the sheer volume of information. Next, it's about managing expectations. Ensure that the organizational infrastructure, for example, community support, is in place to meet expectations in terms of customer experience and quality of the product. Expectations may also differ between the prosumers you have catered to a local scale and the ones you will approach on a larger scale. The standard way to attract finance is through approaching venture capitalists or banks for a loan. However, many alternative ways have emerged to finance your business, as portrayed in these two pictures. In the reading content, we have also provided guidelines for regulation development regarding different countries, a matchmaking tool for SMEs to find the most relevant financiers, and a guide mapping the potentials and risks of alternative finance. As explained in Module 2, the marketing strategy and narrative can change due to the change in prosumer drivers and motivations. Additionally, cultural differences, as explained between Greece, Sweden, and the Netherlands, differ and may affect how the values of a sharing economy should be communicated. Since the sharing economy is still quite new, rules and regulations have not yet caught up. Regulation across countries may differ and can create pitfalls for companies. For example, the growth of Didi has been larger than in the case of Uber. Whereas Uber needs to consider different regulations from the countries that they operate in, Didi has a huge home market in China with the same regulations that apply. Now we're going to talk about the case study of Parkfly Rent. Parkfly Rent had a great idea of eliminating wasted space and resources. However, they did not succeed, and the founder wrote a blog about their journey. The blog link can be found in the reading content of this module. The Parkfly Rent model was based on that people could rent out their car while they catch a flight, getting a free parking and a clean car as a reward. Regular car rental companies spent about half of their rental income on car ownership, which meant costs and inefficiencies. Therefore, using existing cars could save half of the cost in comparison to a car rental company. Even more cost could be saved if parts of the process could be automated. The ambition was to operate 25 airports in Europe by 2020, thereby innovating the car rental and airport parking markets. The success of Parkfly Rent was stated to depend on a formula with 4 components. A was the supply measured in available rental days, which depended on the availability of good cars. The percentage was the percentage of rental. The higher the occupancy rate, the lower the downtime cost, and the bigger the turnover. The euro sign, the turnover per rental day, including additional sales such as GPS and insurance upgrades. The K was the costs, such as operational costs. The first question was which of those 4 components was the most risky. The rental market was transparent thanks to the internet, and the strategy of a price fighter was adopted. The occupancy rate of competition was known, therefore the percentage and the euro, the turnover, seemed safe. The team had experience that indicated that the cost would not be a risk. Then it was the question of A, supply. Pre-research consisted of looking at trends of the market and doing a test before launch. This test resulted in 15 registrations, and participants actually showed up and handed over their car at the departure hall with no insurance in place. All this fed into the assumption that if such an amateurish site succeeded without even one review, press article, or insurer that giving credibility, it would only become easier from here. Prior tests may have indicated obvious insights, such as in the case of Parkfly Rent. However, in the years that followed, the cost of acquisition only increased. Pioneers are easier to convince than early adopters, who are more critical. Also, sometimes less is more, and a simple site often converts better than one that offers a lot of information. Occupancy rate was not a big issue since Parkfly Rent was the first car-sharing platform to be added globally at reputable price comparators, where they competed with the big boys. Parkfly Rent were ranked higher on both price and customer appreciation. Occupancy, which meant realized rental days divided by available rental days, fluctuated between 60 to 65%, but still 10 to 15% behind their competition. This was mainly due to the lack of sites and late development of their API, and due to a too small of a fleet. If more options exist, there can be a better matching of supply and demand. In the case of Parkfly Rent, a faster API could have generated 10 to 20% extra revenue. The importance of connecting fast to channels that the competitors use, as well as building enough supply, was also emphasized. Turnover per day related to that Parkfly Rent aimed to be €1 cheaper than the competitors. Given the very price-driven market, they had to continuously monitor this, which they did manually, and sometimes they lagged behind. A price crawler would have been able to monitor and adjust prices non-stop. Therefore, technologies would have helped eliminate manual work and the risk of dissatisfied customers due to outdated prices. The business model was very difficult because Parkfly Rent had a lot of risk on their side. They were responsible if damage was overlooked at the end of the lease, and it was up to Park FireRent to prove what damages hadn't been on the car, meaning half a gigabyte of high-resolution photos and video material per car. Consider the risk you run to be a matchmaker and how to automate and handle the risk mitigation strategies. And again, start small and test and grow slowly to develop strategies for hurdles that you run into. Content creators are Teresa Thomason and Joris Terlouw, circular and sharing economy experts and co-founders of Circular Action Tools, where we advise companies in how to explore and realize their circular business potential. We consulted expert Peter van der Glint, co-founder of ShareNL and Sharing Cities Alliance, and we held interviews with practitioners as displayed in this image. We have now gone through Module 3. Module 3 also consists of exercises which can be found and submitted on Moodle. Insights from the field can be found in the reading format of this content. Images used in this presentation can be found in the list of the references in Moodle.